Bitcoin is in a bear market. And if you're watching this, there's a good chance that you were told that Bitcoin was going to reach $200, $300, $475,000 this cycle. And you listened. You didn't take profits. You didn't reduce risk because the people you're listening to said that the 4-year cycles were broken and this bull market was going to extend longer than what we've seen historically. Following this reckless advice can work for young people because they can afford to make errors. But if you're nearing or in retirement, you may want to rethink who you're taking advice from. Because Bitcoin just hit $60,000 last week after topping out at $126,000 in October, just a little over 4 months ago. There was no blow off top. And so far, the cycle has played out almost identical to cycles in the past. And so if you're sitting there wondering, how low can this go and how long is this going to last? That's exactly what this video is about. My name is Mitch Moore. I'm a financial advisor to Bitcoiners. I'm not a podcaster. I'm not a YouTuber. I'm not an influencer. I'm a licensed professional that actually manages real client portfolios. And what I'm about to share with you is from a newsletter that we recently shared with our clients on our analysis around the markets overall and what to expect out of Bitcoin in 2026. So let's jump in. As I mentioned previously, this is from our Strong Wealth 2026 investor newsletter that we shared with clients earlier this year so they could understand what to expect or what we're looking at for the markets overall in 2026 and more specifically to Bitcoin itself. So this newsletter in total was around 36 pages. We went through our previous performance from 2025. We also talked through the paradigm shift that we're seeing in markets and just in the world overall right now and how that affects our client portfolios. And then we did an asset class specific deep dive on Bitcoin, commodities, and equities, because those are the three primary asset classes that we invest our clients in. So what you're seeing now is the Bitcoin section where we're going to go through, why did Bitcoin perform the way it did in 2025? And then why are we seeing, the price action we're seeing now here in early 2026? Where do we expect the bottom to be and how long do we think this will actually last? Starting at the top here, might as well start with what most of you want to read about anyways, because your X and Nostr feeds full of Bitcoin analysis just isn't enough. What's going on with our favorite digital beanie baby? And then this meme here, I was told that there was going to be a blow off top and the 4-year cycle would end. Yeah, everybody was shouting that from the rooftops. It seemed like that was consensus. And when everybody thinks they have, the future figured out with Bitcoin changes and proves them wrong. We'll get right to it. Bitcoin's performance or lack thereof in 2025 was quite puzzling to us. If you would have told us the results we achieved in Fluvius in 2025 at the start of the year, we would have bet a good chunk of money that performance would have come from Bitcoin doing Bitcoin things. Turns out it did not. It came from commodities doing Bitcoin things, specifically silver, silver miners, gold, and gold miners. Continuing on, but it didn't. In fact, we didn't even hold Bitcoin by the end of the year. We sold Bitcoin out of this Fluvius strategy, out of our client portfolios on December 1st. The reason we used was puzzling and not is puzzling above is because after we have taken a step back and maybe unplugged from the Bitcoin hive mind a bit, we think we have a reasonable explanation for what's driving Bitcoin right now. There are two components to what we believe are the majority driving forces right now that boil down to perception and liquidity. We'll start with the latter. Liquidity. Put simply, Bitcoin is the premier liquidity-sensitive asset, and liquidity is peaking, or maybe already has peaked. When we say liquidity, we do not mean just simple US M2 money supply, which is what most people refer to on X or just in Bitcoin content in general. They're looking at the M2 money supply and wondering why Bitcoin is not following it. Previous to 2025 or maybe early on in 2025, we saw all those charts going around about the M2 and Bitcoin correlation with a slight lag. Obviously, that got cleanly broken and no longer applies. Nobody pays attention to that. And that's because there's a lot more factors that go into global liquidity than just US M2. Bitcoin being the premier, liquidity sensitive asset, it's specific to the marginal liquidity in the system. And so even if you see liquidity going up over time, if it's going up at a slow rate or just enough to kind of keep the system alive, if you will, that doesn't mean that liquidity is automatically going to go into Bitcoin. We obviously saw the strong Bitcoin performance back in 2020, 2021, and that was because marginal liquidity was flush in this system. There was so much extra money printing from, the printing that they did during COVID. So continuing on, what do we mean by liquidity? Well, we follow and adhere to what Michael Howell at Cross Border Capital puts together for a liquidity index. So for us, we're not experts on the global, financial liquidity system or banking system, if you will. But Michael Howell has been studying this for much longer than we have, and so we lean on his research specifically for liquidity metrics. This index is composed of three primary components. Number one, public sector liquidity, central bank balance sheets. Number two, private sector liquidity, commercial bank credit creation and repo operations. And number three, cross border liquidity, dollar funding markets, and treasury funding markets. Next page. And what his index shows currently is that global liquidity by these metrics has likely already peaked. Even if it has not peaked, the momentum or rate of change of liquidity has significantly slowed since the third quarter of 2025. Coincidentally enough, when did Bitcoin reach its all-time high? You can see this liquidity index shown below. So if I scroll down here, you can see global liquidity starting in 2025. We did get this ramp up in liquidity. However, if I would have shown you this chart, at the beginning of 2025 and said, here's how liquidity will go over the year, what do you expect Bitcoin's performance to be? You probably would have guessed we would get a blow off top. We would get a much stronger bull market in 2025 than we would have seen. But like I said previously, just because there's more liquidity in the system does not mean that will automatically go to Bitcoin. And, what we saw here is, mid 2025, really liquidity started to peter out. It started to flatline and now it's rolling over. And so it makes complete sense why we're seeing the Bitcoin price action that we are now, since the start of the third quarter of 2025 through today, recording this February 12th. But it also makes sense if you just look at over the year at large. So this is one major driving factor. I'll get into the other here in just a second. But continuing on, so if Bitcoin is the most sensitive asset to liquidity and the best liquidity index we have shows that liquidity likely peaked, or at the very least, the momentum has peaked locally, then the resulting price action we have seen since October makes perfect sense, does it not? Now for the second factor, perception. We might view Bitcoin as a safe haven in times of turmoil. And when I say we, I'm referring to Bitcoiners. After all, Bitcoin isn't tied to a sovereign nation and their worthless debt. Bitcoin requires no trust to transact/secure, and the supply schedule is known and constrained, unlike dollars or precious metals. But simply because we know that doesn't mean the market at large knows that or cares. China might know, but they don't seem to care. My neighbor definitely doesn't care. And regardless of how much Bitcoin X tries to scream it from the rooftops, it hasn't sunk in with the behemoths and capital market participants. This message has not clearly been driven home at the market scale. And so, for better or for worse, that's the truth. We're earlier than we thought we were, I guess. Everybody thought that the 2025 or this bull market, if you will, was the institutional cycle. This is when large institutions, more governments, pension funds, all those, type of institutions were going to start entering the Bitcoin market. And we did see some, but we just didn't see it to the scale that we likely anticipated. And we don't think that their perception has quite shifted to how we view Bitcoin. And so, that's why we got the disappointing performance that we got in 2025. Next, whether we like it or not, Bitcoin still trades like and is perceived as a leveraged risk asset. In 2025, with geopolitical tensions rising between the West and the East, along with a supply and demand imbalance in our treasury markets, it was theoretically a perfect time for Bitcoin to shine. But what asset was the winner? Gold. Central banks and legacy institutions still view gold as their safe haven during these times. They don't care about how Bitcoin is better money. They can stockpile the shiny rock in a vault protected by a military. They can see it, they can touch it, and know that it's not going anywhere. They know gold will continue to be what it has always been for 5,000 plus years. They don't have to worry about custody risk, quantum computing, or rogue developers. And frankly, when you look at the recent performance numbers of Bitcoin, they probably don't like the risk to reward ratio of a long-term buy and hold. The chart below shows the total return of Bitcoin and gold over the last 5 years. Before I get to that chart, however, I want to circle back up here to custody risk, quantum computing, and road developers. As much as we want to feel like Bitcoin is a much more mature asset than it was, back in the 2010s, I would agree that it is to some extent. But however, there is still a lot of unknowns with Bitcoin. And, these large institutions, these central banks, they know gold. They have seen gold, work in the past and, changing times of global world order. And they're comfortable just going back to what has worked before. And, once we see these risks with fiat money. And so, unfortunately, like I said, for better or worse, we're still just a little bit earlier than we thought we were with Bitcoin and its public perception. And frankly, the charts and the metrics that I'm about to show you don't help Bitcoin's case. And so this is going to only, confirm the psychological perception of Bitcoin and may cause this to take a lot longer than we thought, which in my opinion, for folks nearing retirement or in retirement right now, that is the biggest risk to their portfolio. If you are over allocated to Bitcoin and for whatever reason, the Bitcoin thesis takes a lot longer to play out than you think, you could be putting your financial future at risk. I would hate to see you have to brush up your resume at 70, 75 and try to earn some money again because you thought Bitcoin was going to be the world reserve asset by now. So it's important as you're thinking about your portfolio approach, especially heading into retirement or maybe in retirement right now, you need to right size your Bitcoin allocation. For us and our clients, we really view Bitcoin in two different ways, two different buckets, if you will. The first bucket is the long-term savings bucket. And so for our clients, this is Bitcoin that's in cold storage, and that is optimized for security, sovereignty, and long-term wealth generation. We're not touching it, we're not trading it. And so we right size that allocation as a buy and hold allocation. But within our Fluvius portfolio that we hinted at earlier, and that you can watch a video on my channel, breakdown of the portfolio strategy itself. Within that portfolio, we view Bitcoin as an investment asset. And so Bitcoin has had superior returns over the last decade. And so it doesn't make sense to just completely ignore Bitcoin with the rest of our portfolio, but I think it makes the most sense to view it from an investor or a trader mindset where we're taking advantage of the Bitcoin performance whenever it is performing, and then we're also protecting the downside for our clients. As I mentioned before, we sold out of Bitcoin within the Fluvius portfolio on December 1st in favor of commodities and equities, which has been a very profitable trade thus far because Bitcoin has fell from somewhere around 90,000 at the time we sold to, at the time of this recording, around 66 to 68,000. And as you'll see here in just a minute, there's a good chance it's probably going lower. But that's how we view Bitcoin for our clients. And I think it's critical for folks nearing or in retirement to start to think about crafting their overall asset allocation in this way. So continuing on with the performance of gold in Bitcoin, not only did gold outperform on a total return over this time frame, it also outperformed on a risk-adjusted basis as shown below. So before we get to the chart below, I'll just talk through this chart right here. You can see Bitcoin in orange and gold in yellow or gold. Gold over the last 5 years is plus 173%. Bitcoin's plus 81%. So this is significant underperformance over this five-year time frame with much more volatility over this time frame as well. And so the risk reward ratio, again, for these large institutions just doesn't look very good for Bitcoin. And it only confirms, it solidifies the perception of Bitcoin, again, being a leveraged risk asset still. And I'll talk more about that here in just a moment. Here's a small chart diving deeper into the metrics for Bitcoin and gold over the last 5 years. As you can see here, the compound annual growth rate for Bitcoin is around 16.7%. I think this is an important call out here, just really quickly. I didn't plan on talking about this, but a lot of analysis that I see online, there's a strong assumption that Bitcoin's going to compound at 30% plus per year into the future, or at least over the next 10 to 20 years. And I don't know how confident that I can be in using that as an assumption, especially when we're coming up with a plan or a strategy for a client's retirement. If we're assuming a 30% CAGR, it's going to make the projections look really good. But what if real life is significantly different? That's what we have to protect against. And I think this, CAGR right here of 16% over a 5-year period, I'm not saying that this is going to continue into the future. And yes, this has been a poor 5-year period for Bitcoin going back to the last bull market, and this bull market's already ended. But at the end of the day, we have to just be honest. We can't look at the market and say that we're right, the market's wrong. We have to listen to what the market's telling us, and we have to have an approach that is adaptable, that can provide for our lifestyle until hopefully, and we still think the thesis is intact, that Bitcoin works out over the long term to the extent that we think it can, and increases our purchasing power significantly. But again, continuing on with the metrics, Bitcoin at a 16% CAGR over the last 5 years, gold 20% CAGR, so almost 4% better CAGR. And then, as I mentioned before, the risk reward ratio just doesn't look good for these institutions right now. The standard deviation, which is a measure of volatility for Bitcoin, was 60% versus 15 for gold. So Bitcoin's volatility over this time frame was 4 times as much as gold with a lower overall return. That's not very good when you're thinking about institutional asset managers. Maximum drawdown, negative 73% versus gold at negative 15%. So again, the risk to reward ratio, I know I said it multiple times, but this just confirms for people who are standing on the outside looking in on Bitcoin that Bitcoin is still a risk asset. No matter how much we, again, stand, on top of buildings and shout it from the rooftops on Bitcoin Twitter, Bitcoiners are trying to get this message across, or this narrative, and get these outsiders to believe these narratives that it's digital gold, it's a risk-off asset, it's a neutral reserve asset. And we can say all of these things, but the numbers, at least over the last 5 years, just don't prove those narratives to be correct. And so that's why we see all the dunking going on Bitcoin X of people who are anti-Bitcoin, if you will. The numbers don't back up our story, unfortunately. Hopefully they will get there, and I believe there's still a very good chance that we will. It might just take longer than we expected. The premise then is that it doesn't matter if it's central banks, large institutional asset managers, or even the everyday investor. The impact of this last 5 years on investor psychology is that it's mostly reinforced the idea that Bitcoin is a risk on and not a risk off asset. We can evidence this point by looking at the chart below, which is one you may have seen floating around as of late. It is the newest of a long line of look what Bitcoin is correlated to now ideas. So you may have seen this chart from Caleb Franzen on X. I think it was a good chart to show that when risk appetite is waning in the markets, Bitcoin performance is poor. Bitcoin rolls over and falls. So the three lines or assets you're seeing here is Bitcoin in orange. In blue, you're seeing ARKW, which is an internet stock ETF. And then the green line is just the ratio between small cap value and small cap growth over this time frame. And you can see here they all peak and roll over at about the exact same point. So the idea here is Bitcoin is still very correlated with the risk appetite in the markets overall. More evidence to this point. Here's a direct comparison that shows this perception is the 24-month rolling correlation between QQQ and Bitcoin over the last 5 years. As you can see below, we hugged the top line for a good duration of this period. For those who don't know, the QQQ ETF tracks the NASDAQ 100, or the top 100 tech stocks in the United States. And so you can see here from this 24-month rolling correlation that they were highly correlated. This means that even if the day-to-day and week-to-week movements didn't match exactly, the longer and smoother trend was highly correlated. Interestingly enough, that correlation seems to be breaking currently. So maybe we're going to get a paradigm shift in markets overall, and Bitcoin's no longer going to be correlated to tech stocks. I don't know. But from the chart that I just showed you previously, it still seems pretty clear that Bitcoin is still highly correlated with risk appetite and marginal liquidity in the system. But continuing on here, the fact that this correlation is breaking now is a longer conversation for another day. But needless to say, this is part of the beauty of having Bitcoin as an investable asset. While it may temporarily have some sort of correlation with other asset classes, it almost never holds. Further, if we would use weekly intervals instead of monthly on the chart above, we would see that while in general the longer term correlation is high, there is a great variation in the interim, which is helpful for us in our quarterly rebalance process. So again, we've built this portfolio that we use for a lot of our clients nearing or in retirement to be adaptable. And with it being a systematic trend and momentum strategy that can adapt to different asset classes whenever they're performing, it's good for us that Bitcoin sometimes is not correlated to other assets. So we can take advantage of that. While other assets might be down, Bitcoin might be up and vice versa. And we have a portfolio strategy that can be flexible and adaptable during those different times to take advantage of these different asset classes. So here's the big question that you're wondering. So where is Bitcoin going from here? We're going to give you the best financial advisor answer that we can, which is that it depends. But I have a lot more context and some specific predictions for you. So don't click away just because I said that. The 4-year cycle is still intact. Liquidity growth is slowing. Risk appetite is waning. Kevin Warsh is an unknown. At the time of writing this, it really was an unknown. Kevin Warsh had just been announced as the new Fed chair nominee by President Trump. A lot of people thought, or consensus was, that he was going to be a hawkish Fed chair. But more information has come out over time, especially that recent Bloomberg article. If you didn't see it, Warsh was hinting at a Treasury and Fed accord, basically hinting at yield curve control, which put simply is the Fed printing money in order to buy treasuries to keep yields low and help the U.S. government finance itself. And so, I think this is, Kevin Warsh, his hand is going to be forced at the end of the day. The math is the math. But he was a little bit more of a wild card as far as what he was going to cause in the short term. There could very easily be short-term pain as a justification for the money printing. That's what we've often seen in history, whether it's the Great Financial Crisis or COVID. There might be another one of those short flash crash type crises before they step in and print the money. And so we have to be aware of that potential, that Bitcoin, again, being a very risk asset, trading like a risk asset still, we have to be aware and accepting of the potential that this could go much lower from here and, maybe lower than any of us think. Continuing on, though, from a technical analysis perspective, Bitcoin has been deteriorating. We believe that we are in a bear market, and we expect that to continue for the foreseeable future into 2026. What does that mean for price? In the chart below, we've roughly identified 2 key support levels. The first is 74,000 and the next is 48,000. Please note that these are zones, not necessarily firm numbers. One note on this, because I see a lot of people on Twitter and other social media platforms, they love to make their predictions as if they have 100% conviction that they know what the future holds. We've seen so many people try to call the bottom in Bitcoin, and they've all been wrong. The bull market is still on. We'll regain $100,000 soon. You've seen it like crazy, and they've just been wrong. Again, that gets back to my earlier point of you have to be careful who you're listening to, especially when it has real world consequences for you and your family. But, the point I wanted to make is the best investors, they think in probabilities, they don't think in certainties, and they listen to what the market is telling them. These are the 2 biggest things that get Bitcoiners in trouble, is they think that they have the future 100% predicted. And as soon as they think that, Bitcoin changes. We saw that in 2025. Everybody thought blow off top, 4-year cycle breaking, very high, Bitcoin price predictions. None of it happened. And so we have to be able to look at the market and take our ego out of it, be unemotional, and be systematic in executing our strategy, especially, like I said, when there's retirement consequences or other type of consequences for your family and your financial goals. Continuing on here, though, so not necessarily firm numbers. Bitcoin recently broke below the first support level and has not regained it as of this writing. So it broke 74,000 and has not regained it since. Will Bitcoin sink to nearly 48,000, a 60% drop from its all-time high? It certainly could, as that drawdown is well within the realm of historical bear market drawdowns, but we don't believe it is the most likely outcome, and we would expect that to mark the absolute bottom. Here's the chart that I previously mentioned. You can see here the support zone, if you will, around 74,000. Bitcoin broke below that. We're at 70,000 right now. Bitcoin went down and touched 59,000, I believe, at the absolute lowest. And then you can see this next support zone down here at 48,000. If this was a chart that had the candlesticks and not just a line, you would see a wick down, the lowest point touching this $48,000 number back in this time frame. And so, again, I think it's, there is a real chance that Bitcoin does go touch this 48,000, price target. And, the other supporting factor to predict that, or to, think that that's possibility here, is because Bitcoin loves to trade to low volume zones. And so, what I mean by that is anytime there's a low volume at a certain price, Bitcoin loves to go fill in that gap. And so, at 48,000, there has been low historical volume at that price action. We didn't spend a long time there, basically, is what I'm getting at. And so, whether or not we go there and hang out for a while or chop, I don't know. Or maybe we just chop here in the $48,000 to $60,000 range, or maybe up to 66 as I'm currently talking. However, I think it is definitely going lower. It's just a matter of what is the absolute bottom in this scenario. In my opinion, I think it's going to be 48. And that would be a point where I would feel comfortable saying with reasonable likelihood the bottom is in. Further, in previous Bitcoin bear markets, prices bottomed out around 45 to 55% below the 10-month SMA. As of 2/1/26, we are 29% below. If the SMA didn't change from today, which it will, that would suggest a bottom of 45 to 55K. So again, this is right in our range around that $48,000 number. And so when there's multiple technical data points pointing to, that range being a strong, next support zone and a potential bottom area, it gives us reasonable confidence that, we can say, okay, if it got there, I would predict that would likely be the bottom. Again, I can't say that with 100% conviction because Bitcoin could easily prove us all wrong. And so that's why it's important to think in probabilities as you're coming up with your own approach and your own strategy and plan for your future. Next, in short, based on the current available information, we are open to the idea that there may be more room to run to the downside, but not much. After the flush earlier this week down to 60K, we believe there is now a stronger case that the bottom is in. Like I said before, this is thinking in probabilities, not in certainties. So we've addressed how low can Bitcoin go. Now we need to address how long could this last. From a purely historical perspective, previous Bitcoin bear markets have lasted 12 to 14 months. If we say that the cycle high happened in October of 2025, that would put the cycle low in somewhere around October to December 2026. We find that this to be a bit unbelievable, honestly, meaning we can accept that there may be a few more months of drawdown/whipsaw around these lows, but it is hard for us to picture how that lasts through until Q4 of this year. Our base expectation is that cycle theory, while not broken yet, will be broken. But it will be broken in this regard, that the bear market is less severe in both drawdown and duration than it has been historically. The biggest challenge to both of these ideas, both drawdown and duration being less severe than historic, is found in the premise that Bitcoin has only operated under one market regime since inception. This is evidenced by the long-term momentum chart below. Read this chart through this analogy. You're hiking up a big mountain. As long as these trend lines stay above the zero interval, you are still hiking up the mountain. If you've ever hiked before, you will know that even when you're climbing up a mountain, you will have some downhill involved along the way, but you are still on the ascent. This is the key. The large fluctuations we see on the chart above are not you ascending and then descending the mountain. They are representative of you going through a short descent while still on the ascent itself. So you can see here's the $0 or the zero threshold of this indicator here. This is a momentum indicator. And since Bitcoin has, market price back in 2012, it has stayed above that zero threshold for most of its lifetime. And so the idea here is that, we have been on the ascent, even though we've had these ups and downs along the way. What does this mean, practically speaking, then? It means that Bitcoin has been in a single regime for almost the entire duration of its lifetime. It has almost exclusively always been ascending the mountain. You can view the large variability of the indicator as the trail you are on while ascending being extremely bumpy. This is something we need to be mindful of because, as we discussed in part 2, the paradigm shift that we are living through could very well produce different market regimes that Bitcoin has not been exposed to since its inception. If you're interested in hearing what we discussed with our clients or what we shared with our clients in part 2 of this newsletter, I'll be sharing that in the next video, so make sure to subscribe to get notified when I post that. One indication that this may be happening is the obvious cycle high to cycle high decline across time shown on the chart. You can think of this decline as your legs getting more and more tired as you hike higher and higher. At some point, you either will reach the summit and start the descent, you will go below the zero interval line, or maybe there will be some external force or event that will rejuvenate your legs. To then put this together, here's where we sit. We believe we have seen the cycle high for Bitcoin and that for now, cycles are still intact. After the most recent flush to 60,000, it is more likely that we have found a bottom, but we're open to the possibility that we still might have one leg lower after the recovery bounce and volatility out of that flush settle. We think that cycles will break, but that break will be on the downside, less severe both in drawdown and duration. The wild card to this is the fact that Bitcoin has been in one dominant regime since inception, and that regime may be changing, which could have unforeseen effects. Long term, we are still bullish on Bitcoin. Nothing there has changed. Despite all the noise about quantum, BIPs discussions, and whatever else you may read, the fundamentals of Bitcoin still remain true: decentralized and uncensorable money. That's the signal through the noise. That's Bitcoin, where it's been, where it's going, and why. But there's something much bigger that's happening right now that goes well beyond Bitcoin. And if you're someone with real wealth that's nearing retirement or already in retirement, then it's important that you understand it. The world is going through a fundamental shift right now. The geopolitical order is changing. Global supply chains are breaking and being rebuilt. And the monetary system that's been in place for the last 50 years is under more stress now than it ever has been in its history. These things are all connected, and they have real direct consequences for how your portfolio should be constructed, especially if you're relying on that portfolio to fund your lifestyle over the next 20 to 30 years. Most of the conventional wisdom around retirement investing, the 60-40 portfolio, bonds as your safe haven, staying heavy in US large cap stocks, was built in a world that may not exist anymore. And if you're still positioned for that old world, there's a decent chance that you could be taking more risk than you actually realize. That's what our next video is about. Subscribe to the channel so you don't miss it. I'm Mitch. Thanks for watching.